Get that open.
No one wants to see that. And welcome to the second episode of the Broker Collective podcast. Joining me, as always, are Trawlerman Lewis Shaw and Jamie Boyband Lennox. How's your week been, guys?
It's been okay. It's been busy, very busy actually. Which
Busy
is
good or busy bad?
a mixture. A mixture. It's been good. There's a lot of new inquiries coming through. So a fast start to the year, to be honest. I think Jamie's had the same. So yeah, decent, but same old issues generally. But it's been okay. What about you,
Jamie,
Jamie?
how have you found things?
Yeah, pretty much echoing from last episode. It's been again another busy week. Lots of leads coming in from new stuff, which is completely out of the woods. It's not it's not existing clients coming back. It is brand new customers, which is good to see. What I am finding though is a lack of ability to send the correct documents. So I'm doing a lot more chasing on the stuff that's coming in, where just documents are missing. So I've got loads. I've got 6 cases to go in, but just missing 1 or 2 documents, just where they've missed stuff off or haven't followed instructions on there as well. But it is what it is. But yeah, good and busy, which is key thing.
What about you,
2024,
Riz?
2024, same problems as all the other years. Getting documents right. I know Lewis's bugbear is sending stuff in different formats and everything like that, isn't it, Lewis?
It is. I'm the king of PDF. I just
King
love.
of PDF.
Yeah. Well. So I'll give you this one. So I've already told Jamie about this. I had a guy who was before Christmas, and I said I need some payslips and documents. And to be fair, the CRM that I use is very straightforward to use. It's a very good CRM. I'll give a shout out to Acre. So I said, yeah, upload your payslips, and because Acre makes it very easy, you can take photos and directly stick them in the client portal in the document store. And he logged onto a laptop and took a photo of the laptop screen of his paste rather than downloading it and uploading it. So he got a phone and a laptop at home and took a photo of the screen. It's it baffles me sometimes. They walk among us, I think, you know.
The joys of PDF. Okay, we have got a patch show for you today, and we've got a number of topics that we are going to be covering. And using my fantastic technological skills, we are going to start off with market data. Inflation numbers came out a couple of days ago, and we were heading in the wrong direction. Well, we are heading in the wrong direction. CPI inflation ticked up slightly, and we have had the first increase, I think, since February 2023. Jamie, what do you make of the revised inflation figures, and what impact do you think that's going to have on our day job?
Naturally, we saw swap rates bounce quite quickly off the back of this. Markets didn't like it, which is quite apparent. Now, realistically thinking about it, they're putting their main arguments around inflation in December is around alcohol and tobacco. Is my understanding from when I looked at it, and it's on the lead up to Christmas. So there's going to be an influx of them products being bought in that period of time, which likely seen this uptick on there as well. But everyone's in dry January now, and everyone's going to give up smoking. So whether actually these inflationary costs are going to come down just as quickly as they went up, which propped it up, I'm probably not too concerned about outticks. I think it will still keep coming down in the next lot of print. Swap markets has kind of settled down a little bit today as well after probably a bit of overarching over such a small increase. But it reminds people though that we aren't out of the woods just yet. And I think this is the real point to take away from it is we can't control the inflation, but we definitely aren't out of the woods, and people just need to be mindful of that. Things may look promising, but it can quickly go the other way. So just don't just assume. Just make sure you get the right advice at the right time. At the moment, I think still.
Lewis?
Yeah, I mean, it never comes down in a straight line, does it? Apparently, that's the stuff that I've been hearing.
The government minister said that on the Sky News. I'd chuckled to myself. He said it about 3 or 4 times.
So yeah, but I mean, to be fair, it doesn't. So if it sticks around where we are now, is that such a bad thing? I mean, the 2% target is arbitrary, isn't it? It's just an arbitrary target set by the government to target the BOE at that. So it's actually quite nice if to have a bit of stability in the mortgage market. I mean, it's great for people, that they're coming up to renew the mortgage or whatever it might be. But it's quite nice to have a bit of stability for a period of time, because last year it was just constantly going up, and then for the last kind of few months it's been constantly coming down. In all honesty, it's almost 3 months. In 3 months' time, it'll be 4 years since COVID started. That seems like a blink of an eye away, and in that 4 years, I think I've aged about 20. If swaps stay where they are, then that's cool with me.
Excellent. Yeah, I think the people. It's so easy to get caught into the whole trap of this little piece of data comes out. It's literally like the day before we had the wage data come out, and that was heading in the right direction. Then we have inflation not only not going down, but actually going up, and then that balancing it out. And then everyone's taking bets on when the first Bank of England base rate decrease is going to be, and how many we're going to have in 2024. I think the most we had was down to 6. I think it's down to maybe 3 or 4 now with where we are. I think it is key to remember that although these pinpoints can, give you an indication of what may happen in the future, nothing is guaranteed. And that's the one thing that we learned from 2023. And I think the lenders are going to be having a very keen eye on the economic data as well coming out going forward. So is there anything else that we want to conclude on market data and what we're seeing? I know the retail data's come out and that's showing it's quite weak. So are we heading towards a recession?
Well, in terms of market data, I will just mention this. So I don't know if brokers are aware, but on Chatham Financial, where we all jump on to have a look at SONIA swaps and all that kind of jazz, you can actually sign up for a free account and get more granular data. And on the SONIA piece, when you're actually logged in, you can see the forward curves. So I don't know if that might be useful for people in terms of when they talk to clients or whatever it might be. I'm not suggesting we should start getting into macroeconomics with people, but it's just a useful thing. It's a free account. You might as well take advantage of it. So that's all I'd add in terms of market data.
Jamie, do brokers need to have an in-depth knowledge on economics and macroeconomics and trends? What do you think?
I think clients are naturally going to lean on our expertise on where we think things are going. And actually, it's quite dangerous if we get caught up in this as well, because the CMAP qualification does not cover that realms of being an expert in this field. Everyone's got an opinion. It may not materialize. It may not happen. It's just estimations. And then the best people in the world don't always get it right at the end of the day. So I think some brokers will fall into a trap at the moment in time and saying fix for 2 years. Because I think I saw a conversation the other day from someone saying, as a broker, saying we're only fixing for 2 years because rates will come down. And if that's the advice they've got, and if that doesn't happen, the broker's next on the line for saying it at the end of the day. So, and the customers base their advice around that. Whereas people need to strip out what's going on with the economy, what's going on with rates, and focus on the customer in front of them. Jesus.
Sorry,
just testing them out, testing them soundtracks out.
Jesus Christ, man.
I have started downloading a few soundtracks that I'm going to add in to liven things up. So I didn't think that was going to go on for that long. So
that's quite a long one.
If you're listening, we are still getting to grips with this software. CMAP didn't teach us how to use streaming software, so apologies for that. Sorry, Jamie.
Maybe I should take control.
I apologise. Sorry, Jamie.
That's fine. So I think the other avenue is, just we need to be sticking to the client in front of us, their needs. So the advice needs to be around career progressions, pay rises, debts being paid off, starting a family, moving homes. Focus on that. Strip away what's going on in the economy, because we can't control it. Because as well, we've got an election around the corner as well. That's going to have another impact. That could have a big sway on rates as well. So it's impossible to guess where they're going to go. We can have an inkling, but we can't be saying that's the client at the end of the day.
I would actually say something on this. So of course it's a common conversation, isn't it? A lot of people say, I want to fix for 2 years because I think rates are going to come down. My response to this, and I don't know if any other brokers, it'd be interesting to find out in the comments when you post this, if any other brokers are doing this. I generally work on a budget.
If any other brokers are listening.
Well, yeah, exactly. So I generally tend to work on a budget. So, we'll kind of nail down, okay, how much can you sustainably afford to contribute to your mortgage payment per month? And so, for example, I've been looking at this, and when I talk to clients, and I had this conversation a couple of days ago where they said, well, we want to spend, I think it was £1,400 a month, and we want a 2-year deal. And that was that with the rates where they were, it was like 35 years. I said, well, if you could afford £1,400 a month, let's just have a look at the difference between a 5-year deal. And what I did is, well, if you could afford £1,400 on a 2, you could afford £1,400 on a 5. But actually, Mr. Customer, look what happens. I can knock 4 years off your mortgage term. So you're going to have a 31-year mortgage as opposed to a 35-year mortgage. Now, in terms of interest rates, no amount of interest rate fuckery, I suppose, is going to make up 4 years of not paying a mortgage. So I think that's an interesting conversation to have with clients, and that's the one I have with clients in terms of, we want a 2-year, okay, but let's just have a look at a 5 because they are going to be cheaper at the moment, and let's see how much we can knock off your mortgage, because actually, in the long term, interest rates, they'll even themselves out, but actually, if we can save 2, 3, 4, 5 years in some circumstances off the term of the mortgage, surely I would say that's maybe not the best advice, but I think it's better advice because you're actually having that conversation, and it can put a different slant on things. I don't know what you think about that. I'm going to open my can of beer.
I think you go for it. I think rates will go up, they'll go down, they'll go left and they'll right. The price you buy a property, if you are buying a property, is really the one thing that you can determine. And that's going to lead me on to my second question. What are our outlook for house prices going through to 2024? Been very resilient in the last year, especially with the hike in rates. Where do we see things going this year? Jamie?
I'm not going to go to the extreme lengths and say there's the 20-30% reductions, which some people claim, but there's got to be some bigger reductions this year. I think the trend of downward trajectory on house prices will continue. The mortgage charter protected a lot of people during 2023. People go on interest only for 6 months. The repossessions order was delayed, I think, for 12 months. So there's a lot of people that's been protected by forced sales so far because of the protections been put around them. And a lot of people haven't rolled on to these high rates. So there's going to be more and more people now that will be going, actually, we can't afford this mortgage, or we thought we could afford it and fixed in, but now I've maxed my credit card up trying to sustain my lifestyle. It's no longer viable and we need to sell. So I think we'll still see a downward trajectory, whether it's, I don't think it's going to be a huge amount downwards, but it could be another 5% down this year. But it only takes an extra government incentive later on this year when they do the budget and say stamp duty holidays again. And if then the base rate does start to come down a bit further, it could go the other way. And that's the thing. It could change on a sixpence at the end of the day.
Lewis?
I would urge every broker that watches this, all three of them, which is us three, I would urge everyone to jump onto YouTube and go and follow a guy called Gary Stevenson. He was a trader at Citibank in the financial crisis, and he retired very young as a millionaire because he got things right. He ended up being the most profitable trader for Citibank. And I follow his videos. I follow him on Twitter. I'm actually going to I'm going to an event for his book launch. I'm going to try and, creep around and be his best friend.
So basically, you're stalking him.
Yeah. I mean,
Joel Goldberg vibes.
Yeah, I think he'd take care of me in the bedroom. He seems very gentle. Anyway, but he seems to think, and I believe him and trust him, that house prices will actually rise. There's a whole macroeconomic backstory that he gives, and it makes sense. And he was one of very few people right at the start of COVID, when everyone was saying, house prices are going to crash. I can remember talking to a BDM at the time, and he was saying, we've estimated that prices are going to come down by 15 to 17% because of COVID. He was one of the very few people right at the start said we're going to see a massive inflationary crisis. We're going to see a huge increase in house prices. So he does have a track record of consistently being right, and his prediction is that we're going to see house prices increase. So I'd urge everyone to go and follow him and watch some of his videos on YouTube, because I think it's very instructive. That's my piece.
I think
So-
you've hit a very good thing. What we should do in future, and Phil did this with regards to on the Yardstick Marketing, he was asking for all the best podcasts that people should listen to, or YouTube videos, and he's compiled a list for financial advisors, because obviously I identify as a financial advisor as well. I think we should do something similar going forward. All these resources that we're always talking about, and these videos and these people that we're following and we discuss amongst ourselves, we should compile something going forward. Jamie, that's a job for you.
Add to the list.
All right, let's
So I think-
go on, sorry.
I was going to say, so if for anyone that just want to follow Gary, on Twitter, he's at Gary's Economics. On YouTube, it's Gary's Economics. Go and have a watch.
Or
Buy
just
his
follow
book.
Lewis, because Lewis will be following him as well.
I'll be following.
Or
Yes,
you can get you can get Gary Stevenson's book's affiliate link in Lewis's website.
Everyone should buy his book. It's called Trading Game.
Boom. All right, let's move on to our next topic of conversation. And we are now going to be talking about, watch for the change of graphics, product withdrawals. That was my voice. That wasn't even any tech or anything there. So
Really?
lender product withdrawals. I'm not going to name the lender. I'll leave someone else to do that. But it sounds
Lewis.
like if a shortened version of somebody who had a company, what you'd call it, and if you had an operation, you might say, I've had a... Well, let's talk about product withdrawals now, and the issue that has occurred where somebody has potentially come out of the blocks very quickly, very eagerly, and potentially not able to handle the influx of business that they will have. I'm going to come into each of you in a minute just to have your thoughts on this topic. But one thing I do want to do, and I want to play devil's advocate here. A lot of people are going to talk negatively and say that if a lender comes up with a deal, they should be able to handle it. And I fully appreciate that. We've all been on the phone for hours or trying to get onto live chats or get into systems and had queuing systems, etc., etc. I get that. But to those people who did manage to get to those deals in that small tranche that did come out, haven't they had a win? So if the alternative is a lender not bringing out some ambitious, I'm going to say ambitious rates, is that necessarily a bad thing if they have done that? And I'm going to come to you first, Jamie, to take your thoughts on that topic.
Ultimately, the customer needs to be at the forefront, and they've had an opportunity to grab some stellar deals across most loan to values, which is going to be a huge benefit to them. A lot of people have saved money at the end of the day. The issue is more from a broker's perspective at the end of the day. And, we've backed the 24-hour pledge back in the summer. And there's been little to no regard to that with these withdrawals on there as well. But I think there's got to be a better way of handling things from a broker's perspective and a client journey perspective. So yes, the rate is great, but is the customer now in for hell for the experience of actually getting the mortgage offer? How's the process going to be? How long is it going to take to actually get the deal agreed? Because there'll be people that are going, could be due to renew in January or the end of January, early February, and they thought, oh, we'll jump out of our current deal. We'll cancel that previous application I've already done in. I'll grab this deal now. And if they're snowed under and taking days, weeks, extra number of weeks actually get to a mortgage offer on there as well, they could have outdone their savings by trying to change lender because they're stuck on SVR waiting for this mortgage offer to be issued on there as well. So that's my concern, is the blowback off it. It's not that they've come out with a fantastic product, which was phenomenal and well above where it should, a lot lower than where it should really been based on where the market was at. But I think it's now going to be the issues which we'll see in the weeks to come off the back of it to get stuff underwritten.
So just to put it into context, the 24-hour pledge was something that we all banded together, and with the support of the broker community, we got some real traction over summer last year when lenders were withdrawing rates with little to no notice. Yes, the background of the market was very volatile at that particular period of time, but I hadn't seen anything like it, and I know that you guys hadn't seen anything like it neither. And we were campaigning to try and get lenders to actually try and give us a bit more notice. Do you think, Jamie, just continuing your point, that lenders have heeded what the community and the broker community really got together? I was amazed how everyone banded together and really tried to, highlight to the lenders that this was an issue. Do you think anything's been learnt from that?
I think certain lenders certainly have. So we've got like Gen H. They've had to adjust some of their products this week, and they've given, I think it's to this weekend to get applications submitted. So I think there's, certainly some lenders that are really taking this on board, especially the challenger brands, because they're thinking, actually, here's a chance to win some kind of accolades with the broker community and put us on the map a little bit of why they should use us over, the safe lenders of what they're used to using. You got the other extremes with some big lenders that ultimately don't really care. They're big enough that they don't really need brokers, and they can do as they please at the end of the day. So there's always going to be, I think we've made movements. I think there was ripples made, a few probably heated conversations from probably certain departments and certain lenders as well off the back of the push of it all. But ultimately, it comes down to the consumer and just making sure that it's the best thing for them at the end of the day. And I think that's the thing that lenders just need to remember is there is someone there, and you plan for emotions when finances are at stake. So I think there's more, although it was quite short notice, you could sense it was coming with the product that's been withdrawn over the last week. You knew it wasn't going to be there for long. The urgency was to get stuff in as quickly as possible. Whereas I think the summer was a lot worse because you had every lender pull in products. So you could be going, X lender is the best rate. Right, let's get this in. Oh no, that's now gone. Right, next lender. Oh no, that's now going to be gone as well. So you're constantly chasing your tail. If you've got one or two lenders repricing, that is just life as a broker at the end of the day. You can handle it. But yeah, I think more can be done in the long run. Accolades for putting themselves on the line to take more applications on. Great, really, good move. But I do fear for some of these applications that are in, how long it's going to take, and whether some of these clients are probably going to need a funeral plan to go alongside the mortgage offer of how long it's going to take to get it as well. So it could be interesting. I think that'll be an interesting one on the next podcast, because I know Lewis has got a couple of applications in with them just to see how they actually pan out and if they can get them through quickly or if they're just still stuck in the pipeline of nothing really happening.
So Lewis, I'm going to bring you in now, and I'm just going to say, be kind. Lewis.
Okay. So this time last week, I was scrambling about trying to get deals submitted to the lender in question, Co-op, when they decided that they were, relatively short notice going to remove their products, which is their, that's their prerogative, and that's cool. But my beef wasn't that they withdrew the products. I don't mind that. Like Jamie said, lenders can do that. That's up to them. That's their, their funding lines, all the rest of it. That's cool. That is just life as a broker. We have to live with that. That's fine. My ire came from the system not being able to cope with the volume that clearly was going in over those couple of hours. And so my issue, I suppose, is that if you're going to launch significantly cheaper products than the rest of the market, and we're talking a big difference. We were talking a big difference. Where even at 90% LTV, we were talking like 0.5%. Now it was an enormous difference between where everyone else was and where they put themselves. And if you're going to put your head above the parapet that far, you're going to get shot. And the issue was that if you're going to come out with market leading products and you've got a new system, the system needs to be able to cope with the demand. And it's the frustration of it took me 2.5 hours to submit 2 applications because I kept being kicked out, logged out, crashing, all the rest of it. So something that would ordinarily take me 20 minutes took 2.5 hours. And it was the frustration of not being able to get a deal submitted when you've got all the documents, you're good to go, you've given the advice, you've provided the recommendation, you've done everything you need to do. And then the actual doing bit, which should take no time at all, I'm kind of sat there still kind of refresh at like 10 to 5. I got it in at like 16:57 or something. And that was my gripe. Not that they were pulling rates, that's cool. They can do that, They did obviously go a little bit too sharp on their margins in terms of where they put themselves. But the problem is that, let's be honest, there's a bit of a track record for this. And that's again something that perhaps there's no point not feeding it back, is there? I don't understand why you would come out, smash it out of the park for like a week, get hundreds of applications in that you probably can't cope with. Like Jamie said, I mean, I couldn't even package the case. So I submitted on Friday, but because then it kicked out and the system was a bit knackered. Then they did some maintenance. So I couldn't even package the cases. And so, in terms of, let's be honest, we've seen them do this before. Why not just do what every other lender does and sit in the mix? That was my gripe, to be honest.
I don't think it'll be the first time that we have this situation. I think that we're going to see this a lot more going forward, where lenders come out wanting to price aggressively, and then the business levels exceed their expectations, or they get caught short, or like last year, before they know it, they've blinked and they're standing out a country mile on the sourcing systems. But that comes off the back of market volatility. If the markets are calmer, then there shouldn't be as much issue. So like we said before, I think we're not out of the woods yet. I think if rates do continue to go in a downward trajectory, then happy days. It shouldn't be as much of an issue. What do we think about lenders? And we're going to come to another point here. Lenders, when you've got the offer in and they reprice downwards. In my perfect world, and some would argue that this would may negate the need of a broker in some instances, if a lender offers at rate X and then they pull down that rate on a 2-year fixed at the same LTV, should the lender automatically reprice downwards, whether you go direct to them or whether you go through the broker channel? What do you think, Jamie?
Ultimately, from my point of view as a broker, I would love that because it would save loads of time. But I live in the real world, and ultimately banks, building societies are businesses. It's like if we go to a shop, it's like you buy a product at full asking price, 50 quid, and then a week later it's then 40 quid. Should you then be able to go take it back, rebuy it at £40? You've bought in at that price at the end of the day. There is a luxury that you can go and redo it again. The other issue as well is the product dates changing. So although you can have a 2-year fixed rate, it's for most lenders, with the exception of someone like Nationwide, it's 2 years and 3 months it's running for. So if you applied 6 months early, you end up with slightly less than 2 years. But then the actual end date of that mortgage product could change in that 6 years. You change the product multiple times. So if there's a need for, I need to be moving by a certain day, and you tied that product in there as well, there is the risk that that's device is actually being changed, because actually they could end up with 6 months more on that mortgage offer than they potentially had hoped for at the time of applying. If everyone took the same approach, such as say Nationwide, and you get 24, 36, 60 months from the month the mortgage completes on, that's a little bit different. There could be an argument of things should automatically drip down into a cheaper rate, and that would be more easier to facilitate on there as well. So it would be nice to have. Do I think it's going to happen? Probably not, because they're businesses. I think for brokers,
even if they charge a nominal fee for doing that, because over a 24 or a 60-month period, a 20 or 30 basis point drop on a decent sized loan is going to be quite big, isn't it? And the end of the day, there's nothing stopping us from contacting the lender and doing it. If they went to the lender directly, they probably wouldn't maybe even never be contacted and told that that's the situation. So, they could charge a fee, couldn't they, to take into account their re-administration, to re-offering something. I understand also there's a hedging issue here potentially as well.
I don't necessarily think it's just purely about the actual products at the moment. I was trying to forget what I was going to say then. I don't really think it's just purely around hedging the bets on where it's going to go and buying at a certain price point. Because if we really think about this, actually, there's going to be. I've lost my train of thought, which is unlike me. Sorry, my wife just at the window, just waving at me. So I think hence why I've lost my train of thought.
Everybody
But Riz, you just
wave
want to
to Lewis's
ask me
wife.
that again, mate. Maybe crop that
So-
bit out.
Lewis, you
So
jump in.
I'm not even. I don't think that lenders. Well, they won't do that automatically. I don't think, and nor should they. It's not. At the end of the day, lenders are there to make a profit. They're not. They're not a public institution. It's not a charity. And if I apply for a mortgage and they say that's your rate, then that's your rate. I mean, I think we get. There's only so much they can do. And it is incumbent upon us to maybe allow them that leeway. Not to mention, I spoke to a chap a few days back, and he'd been told by a BDM of a buy-to-let lender that on one day they had 10,000 PT cancellations in a day.
Wow.
Now, think of all that additional administrative work that would had to be done by that lender. All that money that had been maybe hedged at one price and was, I think we need to be careful with this, because if lenders turn around tomorrow and go, look, we're not having this anymore. You've made your application. That's your offer. We're not going to change it. Because it could go, the old law of unintended consequences. If this becomes too much of an issue, they could just stop it. I mean, I know of a conveyancer where they're on something like the 6th mortgage offer, and they've now started charging. So they did the first 3 for free in terms of the updated reports and all that kind of stuff. And on the 4th, 5th, and 6th, they've charged a nominal fee of £100 each, so £99 each time. Because customers, understandably, will want the very best deal. Of course they do. But they have to appreciate that it's not quite as simple, depending on the lender, as a click of a button.
Doing a mortgage isn't as simple as clicking a button.
Well, yeah, quite. But also,
the world you live in, it's easy. Client comes and tells us what they want. We click a button, and the mortgage is done. Job done.
Yeah. But also, there's this whole thing of, are we making customers aware that actually with some lenders, it may rescore them? So there is a downside that, I spoke to a guy, it was a few weeks back, where that very thing happened. They wrote a mortgage offer. The customer wanted to go for a cheaper deal. It was about 0.2% difference. And the broker did say to them, look, in order to do this, they will rescore you. And if anything's changed in your credit profile and all the rest of it, it may well decline. It was a high LTV application, and it did decline. And then as a consequence, that customer then no longer met that lender's policy. They then had to rush around and get a new deal, which was more expensive than the original deal. So, there's a downside to this. So I think we have to be careful what we wish for.
So the reason that we're doing that I'm asking that question, is obviously in 2024, the deals that have come out, some of them seem to be lower than the ones that were secured in 2023 in some cases. That moves me beautifully, the way I segment it from one way to the other. That moves me beautifully in the next section. Do we think lenders are done with the bulk of their rate cuts for now. I'm not talking about 10, 15 bips here or there, even upwards or downwards. I'm talking about some of the steeper discounts that came out with some of the lenders in the first couple of weeks of this month. Are they done?
Yes. There we are.
There we go. Bang. Money. Jamie, keep it brief.
Yeah, it's definitely going to man, a few words. I definitely think for the time being, we're certainly done. We saw some really big reductions to start this year off the back of swaps dropping quite heavily in the end of December and into the start of the year. I think now we've kind of found our level for some period of time. Personally, may not happen as this way, but I think until we see a base rate reduction, I think this is kind of the price point we will settle at for some time until the first move from the Bank of England's made. And then we may start to see some more sizable stuff going the other way. I think in the interim period, you're going to see people pricing for margin and pricing for being the top of the pile for a certain period of time when they want the business. And it'll be some headline rates, but say they're reducing 30 basis points, but it'll be at one product and the rest of them are at 0.05. So I think there's going to be minuscule pricing, but nothing dramatic in the interim until the base rate started to come down.
I think we need something strong to come out, or for swaps to go in a certain direction. I think for lenders to try and balance that service element, which we're going to start hearing about. We're trying to balance the service, keep the service standards to where they need to be, and just to really see what's happened. Whose is that? I'm getting feedback. No,
yes, Lewis.
It's probably Lewis. He's just come off the trawler boat and now he's freaking messing with the tech. Yeah, so I think the lenders are going to wait and see what happens until some decent data comes down, or there's a lot more confidence within the market, and they'll balance that off with service. So from my point of view, I think the rates are the rates as they are at the moment. But let's see what happens going forward. I was going to talk about conditional selling, but I am now going to quickly jump to our next topic, which is the budget and the election, because I think the budget is going to probably be something that is really going to shape maybe a kickstart to the housing market if there are SDLT, stamp duty, land tax incentives in the budget. Now, just keeping apolitical as we are, and obviously showing no favoritism to anything, but when the current administration leave and the new administration come in, what do you think is going to happen and the outlook is going to be for the budget and the later election that we have this year? Lewis, what do you think?
I don't think there'll be a huge difference in all honesty. I think the structural problems we've got can't be fixed overnight. There's no silver bullet. Definitely no silver bullet.
Lewis, is there a silver bullet?
No.
Okay, just to be clear.
I think the kind of overarching drivers of house prices and all that kind of stuff, they're too big for I think any individual political party to wield without some serious, some huge interventions, which they're not going to want to do because they get tarred with the same old brush. So I don't think there's going to be a huge change. I'm quite pessimistic about this, and I wish I wasn't, because I'd rather it was the opposite. But I think we'll see home ownership rates continue to reduce. I think we'll see house prices continue to be out of reach of a lot of people. And I don't think there is the political will to do anything about it, because in order to do something about it, you'd have to do something that was so unpopular for so many people, it would just be politically toxic. So I don't envisage that changing.
Jamie, do you think one suggestion from Labour about longer term fixed rates, do you think that will smooth out and that could sort out the issues that we have in the housing market?
I think they're looking for something that's potentially not there. Personally, I think as a country, we're not geared up for long-term fix like America is, like the rest of Europe is. I used to work with this chap who was from France, and he used to say they buy a home and they stay there forever, but they just extend it, they make it bigger. Whereas as a country, we'd love to move house quite regularly. So it needs to be a product that has that air of flexibility if they do bring it in. But I think you said this on a podcast there in the week, Riz, is the argument for long-term fixed was back in 2021 when rates were ultra low. While rates are high, no one wants to fix in this price point any longer than they really have to. So I think I don't see it being a solution at the end of the day. And I know some lenders talking about enhanced affordability with longer term fixed rates. Affordability is already stretched in the best part of high interest rates. So I don't see it solving any real problems other than long-term financial distress for people.
I've got a real beef with these long-term fixed rates. In fact,
do you know what I've got beef with, Lewis? Your tech. Can you please invest in some headphones and a microphone? Me and Jamie might have a whip round and get some for you.
Well, do that. It's because I'm from the north. I'm poor. So, I was actually going to go into the office today, but when I woke up, I just couldn't be arsed. so I would have done that. But no, I have a beef with these long-term fixed rates simply because America's in the grip of a huge housing crisis. They've had long-term fixed rates for donkey's years. Canada's in a massive inflationary housing crisis. They have long-term fixed rates. We can see. So I actually went and did a bit of digging on this. In fact, I've got a list. Let me grab my phone.
Was Gary Stevenson with you while you were doing this digging?
Yeah. So where was it? Let's have a look on here.
Let's talk amongst ourselves before Lewis finds his data.
No, it shouldn't take that long.
Back of a fag packet.
Where's it gone? Can't find it now.
Written on the back.
So basically, there's a ton of countries that were all very divergent in terms of their economies and all the rest of it. So on that list, there was like Luxembourg, Turkey, France, Germany, the US, Canada. What was the other one? There was not one. Oh, the Netherlands, Germany. They've all got problems with housing. And most of them have long-term fixed rate mortgages. If that's the answer, why is it not fixed it over there? Moreover, on top of that, the lender that's out there now and kind of going, oh, we can do 6 times income. If you introduce more credit into the system without more real resources, without more houses being built, you're only going to push house prices up further out of reach of people. So it doesn't say. What frustrates me is they say it's going to solve the problem. It won't. It will actually make it worse. Because if people can borrow more, they will borrow more.
Well, solving the UK's housing crisis, I think, is going to be one of the topics for our next podcast. I think that. I don't think anyone's got the magic answer. I think a lot of stuff is going to be thrown out during this budget coming up in a few weeks' time. If an SDLT holiday is a good thing or a bad thing, I'm going to defer on that. But to get the market moving, and no one's going to win any elections if there's feel-good factor isn't in people's homes. And if they don't feel that their houses, they've got the ability to move house, or their house prices are steady, or they're going up in value, I don't think anyone's going to win any elections in the UK. So I think everything will be chucked out in the budget. I think that will be their last foray, really, that they can do something. And if George Osborne was right, and that date in, I think, mid-November is when we do have the election, they really need to get it going now. I think people who are moving will benefit, especially if there is an SDLT holiday, but I thought that was going to be done before Christmas, and it wasn't. So I don't think there is any magic pill. All I think we do in this country is just move things slightly up the hill for it to later roll down the other side twice as fast. But there we go. We're going to stay apolitical. And that's going to move us very interestingly on to our final topic of today's podcast, and that is conditional selling. Now, before we all start sharing our tales of clients being told that they have to speak to an in-house mortgage advisor if they want their deals to be presented, I do want to caveat that not all people and all agents and agencies operate in this way. It's only the case that the ones that don't and who do sometimes fall foul, and sometimes it is the big players in the market do that. So before we do anything, I don't want to say anyone say that we're bashing estate agents or anything like that. But what's been your experience recently, Lewis, in terms of conditional selling, or what have you heard of?
So recently, a client of mine made an offer on a property. It's still being negotiated. I spoke to him last night, actually. So he made an offer on a property, and straight away, you've got to come in and do this, you've got to come in and do that, you've got to come in and do the other. And he rang me. It's a first-time buyer, confused. He said, "What's all this about?" He said, "Why do I need to do all this?" I said, "Well, the reality is that you don't." And I tweeted about it, and it's surprising now what the power of a tweet, because I tweeted about it. A couple of journalists picked it up and went straight to the company in question and asked them for comment. And lo and behold, he now doesn't have to do it. Isn't that odd?
That's really surprising. But Lewis, I keep on hearing the same culprits over and over again, and they always put it down to a training issue. Apart from us communicating this with clients, and it's easy for us to say, look, if you do go in there, you may be asked to prove evidence of your financing. They may offer to speak to the in-house advisor, but it's your prerogative whether you do that. If somebody goes and sees that dream home, and people tell them, well, if there's two people interested, and if you don't speak to our guys, we can't control it, and it's not going to put you in the best way. How do we solve this problem?
We can't. Whilst ever financial services are located within a state agency, you can't remove the risk of that happening. You can have every training course under the sun. You can say that it's not going to happen and all the rest of it. But when people are targeted to book FS appointments, and when they're selling one product, as in the only product that you want, it's too easy to fall into that trap. So I cannot foresee a time where this doesn't happen. Now, it's a shame because, as you rightly say, it's not everyone. There's some great agents out there that have in-house brokers. There's some great agents out there that have good relationships with brokers and will pass on details and all the rest of it. If that person, Riz, what are you doing? If that person wants to speak to someone, that's fine. And there's nothing wrong with asking the question. Of course there's not, but there's an obvious conflict of interest when it's in-house. There's an obvious risk of conditional selling because you've got the one asset that they want to buy. It's not a free market, is it? It's not. You can't walk down the shop. You can't walk down the road and get it from another shop. So I don't foresee that this will ever stop unless agencies divorce from financial services, because clearly the companies that do engage in it have had long enough to be able to self-regulate. It's clear that they can't.
Jamie, how do we solve this?
I kind of have to echo what Lewis said around that, because while there is that direct link between estate agency and FS when they're owned by the same people, there's that financial incentive and there's that push for that. And there is some of these estate agencies that are loss leading and just kept afloat by the FS side of things as well. So there is that real risk that there is a very big carrot dangling there to get people on bums on seats in front of their advisor. And when we have these often news articles around the big estate agents that say, it's either an isolated incident or brokers are currently just hammering us because we're such a big player in the game. That's not really the case, because when you think that most brokers are generally cheaper than some of these big corporate agents on the fee, we've got bigger lender panels and we've got more insurance providers on there as well. So the proposition across the board of the vast majority of brokers that are independent is far superior than they're offering on there as well. So I think this is another reason why they have to push so much, because their offering on paper isn't fantastic, and there has to be kind of guerrilla tactics to get people in front of their advisor. Otherwise, they don't do business.
Do we need to do more to educate clients and first-time buyers and say, look, this might be the situation when they're being told that it's an affordability thing to see if you can do it? The way that it can be structured can very easily convey that message to them, can't it? And as a first-time buyer, and like you've seen this property and it's your dream home and it's your inverted commas forever home. If I had £1 for every time I've heard of forever home, how do we? Is it an educational piece? Do we need to band together and push the word out?
It falls very much. I'll get Lewis. You can go first. I went last time out.
So I think it is an educational piece, but how bad is it that we have to educate clients to say, just be aware, I'm just going to tell you about this. It's illegal. It's not. It is banned. It's not. It is against the law in terms of trading standards and all the rest of it. But I need to educate you because you are going to come across this behaviour in our marketplace. How mental is it that we're even having this conversation in terms of we need to educate clients that they're going to find this? I mean, everyone knows this happens. Everyone knows it happens. So yes, of course, we do need to educate people about it. But ultimately, it comes down to if you've got bad actors, unless you've got someone that can stand over them with a big stick and say, if you do that again, I'm going to hit you with it, they'll keep doing it. And there is, until agency is regulated in some way, in the same way that we are, it will continue. I mean, think of this. It's crazy, isn't it? So we're regulated by the FCA. The conveyancers are regulated by the Solicitors Regulation Authority, the SRA. Surveyors are regulated by RICS, the Royal Institute of Child Surveyors. And yet the person selling the asset, nothing at all. How is it that everyone else in the transaction has to be regulated to within an inch of their life and professionally qualified and all the rest of it, but the people selling the asset doesn't matter? That just seems to me so bizarre.
I completely agree, and I don't think this issue is going to go away. But like I said before, this doesn't apply to all agents and agencies. No. This is a small number of people who spoil it for everybody else. But I know a lot of brokers, when it does happen, call it out and publicize it. And if we just keep on doing that, then hopefully something will change. I think, guys, that brings us to the end of the second. We've made it to number 2 episode of the Broker Collective podcast with myself, Jamie, and Trawlerman Lewis. If you have any topics that you would like us to cover, we have these podcasts every fortnight, then please contact us and drop us a message in the socials and we will cover it. We're going to start, I think, in a few episodes' time, having guest speakers along as well. So if there's anyone or anybody you particularly would like to hear from, or if there's something or a trend that you think that we should get an expert in to discuss, then please let us know. So for today's episode, thank you very much, Jamie and Lewis, as always, and we will catch you on the next episode. Take care, guys.
See you later, guys.
Bye, bye, bye.
We can only finish in one way, can't we?
Go on.
Oh yeah, oh yeah, oh yeah, oh yeah, oh.
I think it just goes in a loop. Take care. See you later. Bye.